Hello, and welcome to another interactive session on our live webinar series, Moneyfy Mantra, where we speak with industry experts on various personal finance topics to help educate our viewers on empowering them to manage their personal finance more efficiently. Our today's topic is on understanding scope and opportunities of multi-cap funds. And to cover this topic, we have Miss Shaily Gang from Tata AMC. Shaily is head of products, managing largely equity and debt mutual fund products at Tata AMC. Shaily, welcome to Moneyfy Mantra.
Thank you. Hello,
Uh,
all.
so, ju- yeah. So just a quick introduction about Shaily. Shaily has been associated with Tata AMC for more than 3 years. She has rich financial services experience of over 17 years across various areas of banking and wealth management. Now, before we jump on our topic for today, let me just give some details on our Moneyfy app. So Moneyfy was launched 3 years back, and now we have more than 1 lakh user accounts on Moneyfy, wanting to invest in mutual funds 100% digitally. One can start investing in mutual funds with SIP. They can also invest into lump sums and apply for all types of loan and insurance products. You can download our Moneyfy app. We have given the link on the description below. So please do check out. Also, please subscribe to our Tata Capital's YouTube channel and follow us on Facebook to get the latest update on our various financial products. Uh, I would also request all our viewers to share, if they have any questions on the comment section, and we will take those questions towards the end of this session. Yeah, Shelly. So over to you on understanding multi-cap funds today.
Thank you, Harsh, and thank you, Moneyfy, and a warm welcome to all the Moneyfy viewers. It's glad to be again coming here and talking to you all, presenting to you. So just give me a quick moment to share my screen. Um, yes,
Yeah, I
it's
can see this.
visible, right? Yes, yes. Okay. So the discussion the topic of discussion is Tata Multicap Fund. It's our NFO from the House of Tatas. Um, However, before that, there are a few context setting points which I would want to mention, and then I would briefly cover the fund, and then we can go on to the Q&A. So, equity is the best asset class in long term. As you can see, what has been plotted here is the 1 year, 3 year, 5 year, and 10 year returns for various asset classes, and these asset classes are represented by specific indices. Like equity is represented by Nifty 50, and gold is represented by the spot price of gold on the exchange of MCX. Likewise, real estate and fixed income. And the takeaway here is that the long period returns. Let's look at the 10-year returns, equity returns. The CAGR returns are higher at 11.86, close to 12% as compared to other asset classes. Even 3 year returns, equity is standing tall as compared to other asset classes. Of course, in the last 1 year, and this data is as of 31st December 22, 1 year, of course, we all know Nifty and Sensex are at 4%, whereas gold, of course, has fared better. But long period returns, equity is a relatively better asset class, when we speak about long period returns. This is another slide put together for this session to bring out the fact that equity is one asset class, or is the only asset class which is more probable of beating, the CPI or the inflation, or the rate at which the average spending of the household grows. So what you see here as the CAGR is, the household expenses, and since 1990, at what rate have they grown? Of course, inflation, let's say, is at 6.5%, on an average, or CAG annualized inflation for the period 1990 to 2022 is 6.5. But, if you consider education inflation or healthcare inflation, which are much higher, 10%, 15% rates, they have grown at a higher rate, and the costs have grown much faster as compared to the average inflation basket, average, basket of products. And that is why you see the household expenses from 1990 growing, at a rate of 9.75%, close to 10%. And the CPI the CPI inflation, average CPI has been at about 6.5%. Gold, of course, is the returns of gold on an annualized basis since 1990s, approximately 9%. Fixed deposit tax, of course, is considered here, because what happens is, when you book a fixed deposit, irrespective of whether you redeem the deposit or keep it, you have to pay a tax on the coupon that you earn. So that is why post tax, the fixed deposit CAGR is at about 5.6%. And equity returns, which are represented here by Sensex, is at close to 15%. So, one is that historically, equity asset class has given higher returns and has a higher probability of, clocking better returns than any other asset class. And the other part is looking at the growth rates of the average spending of the households, or the inflation, or returns from other asset classes like gold and fixed deposits, and of course equities. When we compare all of these, we realize that equity is one asset class which can beat inflation well, and also cover or be a better guard for, or better be a better guard against the household expenses, which grow at a higher rate. And some of the expenses like education and healthcare are, they grow at a much faster rate. This is just an asset allocation grid, considering the time to goal. What is the objective? Whether it is to beat or manage market volatility, or it is to gain capital appreciation with some volatility, or to build wealth over the very long term, having an aggressive profile. And while you have your time to goal in place, and you have the objective in place, any portfolio would have three parts to it. Ideally, a liquid portfolio, so that you can reach out and encash that portfolio within a day, or and a core portfolio and a satellite portfolio. A core portfolio is something which is perennial, and exposure into the portfolio will always be there to this part of the portfolio. And funds which can go and sit in the satellite portfolio are those where you would take a tactical call, on entry and exit. So when you map out your overall portfolio like this, considering all mutual fund categories, and taking the time to goal in perspective, what objective it is, and your risk profile, and the three parts to your portfolio, which is liquid, core, and satellite, multi-cap funds sit right, in the middle, as part of the core portfolio. So this is, putting things in perspective of where does the multi-cap fund, the category which we are talking about, actually lie in the overall canvas of the portfolio. Next two slides I would want to just spend, and then after that we'll jump to the NFO, or the new fund, for discussion. The risk reward positioning factors. Now you have various funds and various fund categories. These are various lens, or these are various aspects of the fund. So fund could be having a multiple asset classes of equity, debt, commodities also, or it could have a standalone asset class, just a pure equity fund or a pure fixed income fund. If it is an equity fund, it could have only a large cap, market cap exposure, or it could be a mix of all three: large cap, mid cap, small cap, or it could be standalone market caps, like only large cap fund, or a pure mid cap fund, or a pure small cap fund. Then the other perspective to the fund is concentration. Whether are there any minimum number of stocks defined or not? Whether the fund which is in discussion is overall diversified, or it covers or captures only a part of the market, like one sector of the market. So it's a sector fund, or just a thematic fund which is capturing 2 to 3 sectors, or one theme covering 2 to 3 sectors. So is it a broad-based fund, covering the entire market? Then it could be a active fund or a passive fund. Active fund is basically where the fund manager takes specific calls on the individual stocks, and passive funds are those funds which just replicate the respective indices. It could be Nifty 50, Nifty 100, it could be Nifty Next 50, or Mid Cap 150, those kind of indices. And then these funds could be running, it could be a growth fund or a value fund, or it could be growth at reasonable price, which is midway. The funds could have, bottom up approach or a top down approach. Top down approach meaning it would look at, the fund manager would look at the macro situation and then take a call on which sectors to go and take exposure to, or it would specifically go by the company, by and study the company in detail and then take a call ground up. That's why it's called a bottom up approach. And finally, when the portfolio is constructed, the sector exposure, the percentages towards various sector exposures would be incidental, largely incidental, because he's taken one company and constructed a portfolio, and those companies could lie in whichever sectors, and then the sector exposure could come in. It could be a portfolio having a good mix of earnings, only large caps would be largely earning stability, or mid cap and small cap, or like a multi-cap fund would have a mix of earning stability and a surprise earnings, where it's a smaller company and the fund manager today has taken a call to invest into that company, and the larger market is slowly placing its bet and getting convinced. The entire market probably right now is not convinced, and as a larger portion of the market gets convinced, the prices would keep going higher. But the fund manager has taken a call today that, yeah, this company is expected to do well, and the larger market will realize the potential of the company in some time to come. In that case, in such a scenario, the return potential of the stock is higher. And active weights, so there is always a benchmark against which the fund is positioned and expected to be measured. So let's say the benchmark has about 50 stocks and the fund has about 30 stocks or 50 stocks, and whether the fund is taking an overweight position or an underweight position, or whether the fund is going overweight a sector or an underweight a sector. So these are the various ways in which a fund can be constructed, or these are the various lenses through which you can look at a fund, and these are exactly the reasons which decide the risk reward positioning of the funds. And only a pure large cap fund would lie lower in the risk reward potential matrix, and a sector fund would lie higher in the risk reward return potential. Multi-cap is somewhere in between. So now we come to the multi-cap, some slides on the multi-cap. Now, multi-cap is one fund which is one category where the regulator has mandated that minimum 25% allocation needs to be there in large cap, mid cap, and small cap segment each. And the balance, the last 25% could be loaded onto any of the market caps. That's with no other category in the mutual fund currently mandates such a higher exposure to relatively higher exposure to mid and small cap. So there are categories like flexi cap or focused funds, which are free flowing. The fund manager can decide what percentage of the allocation needs to be in large, mid, and small. But the regulator has said that in a growing country like India, if you want to, take exposure and if you want to benefit out of the broad basing of the economy and the market, then it is beneficial for a fund and the investor to have a relatively higher exposure into mid and small cap fund. Then at least one category should be available in case an investor wants to go and capture that kind of broad basing growth from the economy and the market. So it is like three market caps coming together. Of course, there is a mandate to have minimum investments in each of these market cap. And the power of three market cap coming together, we've just compared it and put an analogy to it, saying that how earlier all these gadgets were different. A calculator was different, a camera was different, a writing pad was different. Now everything is, you can type it out on a memo. You have a camera in the phone, you have a calculator in the phone, you have an alarm clock in the phone. So individual things coming together, and your phone actually has become a very, very powerful gadget for you. Similarly, you have this Swiss knife. So earlier, all the tools probably were different, but now you have a toolbox, or you have a travel, tool kit, or a travel Swiss knife, which is there, which has, multiple tools attached to it. So the power of things, multiple things, or multiple utility things coming together. That's the analogy we thought we would draw to convey the power of multiple individually good things coming together, but when they come together, they actually make a better product. uh, a whole is greater than sum of its parts. So like tin has a hardness of, let's say, 1.5. Copper has a hardness of 3 units, and when you combine tin and copper together, you don't get 1.5 plus 3, which is 4.5 hardness metal. What you get is a bronze metal which has the hardness of 6, which is much more than the individual things just added together. So that's the idea, and that's the power of 3, or a power of things coming together. Now, what here we did was, we said, let's plot the historical, or let's plot the returns of large cap, mid cap, and small cap segments, calendar year wise, and see historically who has done what. And as you can see, the returns from large cap, which is represented by Nifty 100, the large blue box, they are all scattered over. They're all over. They have been at the bottom multiple times, the worst performers in that calendar year, and they also have been at the top, been the top performer in that calendar year. Similar is the case with mid cap 150 and small cap segment as well. We said, okay, if somebody was to invest looking at the previous year's winning segment of the year, then what happens? So let's say at the start of calendar year 2013, somebody looked back and said, okay, mid cap was the best performer in calendar year 2012, which is this 44%. And let me invest my monies, in the entire money into mid cap in calendar year 2013. At the end of calendar year 2013, which is the start of calendar year 2014, again, the investor would assess, okay, last year, which segment performed? So it was Nifty 100, which was the large cap. And then he moves his money from this mid cap to large cap, because last year, this was the better performer. Again, at the start of calendar year 2015, the investor looks back and sees in calendar year 2014, small cap was the best investor. And he was actually invested into large cap the earlier, looking at the previous year. So then he moves his entire money from large cap to small cap, because whole of 2014, small cap has been the better performer. So at the start of 2015, he would invest his money in small cap. Likewise, he does it for all calendar years. And what has been found is, by doing this exercise, he's picked the top performer, or he's been invested in the top performer in hindsight 3 times over 10 years. But he's been in the worst performing segment 4 times over 10 years. Now, if the same exercise was done looking at the previous year's losing segment, the same thing, start of 2003, look back, and instead of investing in the best performing, the investor said, okay, I'll perform in the worst performing, because that's like more likely to perform better this year. And same exercise was done. Again, it was found that the investor was exposed, or he picked the top performer segment in hindsight 5 times over 10 years. 50% of the times he was right. And he was still wrong 30% of the times. What we said was, why not make a composite portfolio of, let's say, 40% large caps, 35% mid cap, and 25% small cap. And then by doing that, the investor would have a smoother ride, a better risk adjusted return, and still a more stable portfolio, and still a better return, not the worst of the returns. So a combination would give a smoother part, smoother allocation. And also, as I mentioned, in a world which is slowing down, India is growing at least at a 6% growth rate. Inflation is not so much of a problem at our end, and we have managed it, and inflation has come down. It was more of a problem in the global and developed markets. Are so in growth is fine. Inflation, we were not we did not face too much of a problem. Yes, of course, we faced high inflation as well, but unlike other developed nations, our problem was on inflation was relatively easier to manage. Our macro is better. Our currency, we have good forex reserves. 8 months of import cover we have, and so our macro situation is better managed. And we have multiple themes which are helping the India's GDP to expected to grow better because of the China plus one, and the boost to manufacturing which the government has given. China plus one theme is a very, very important theme, again, from the manufacturing part perspective. Each country, almost all companies in US and Europe are looking at they are looking at alternative manufacturing based country other than China. And India, amongst a few other names, is one of the beneficiaries of the thing. And if that happens, obviously it will provide a very good boost to the GDP. So uh, in a situation like this, obviously the economy is broad basing, and when the economy broad bases and markets broad base, mid caps and small caps tend to perform better. And if multi-cap is one category which has a mandate of minimum 25% in mid and small caps, then and it is one category we have seen historically which is expected to have higher allocation to mid and small caps as compared to other funds, because all other categories are largely positioned into 70-75% or even 65% into large caps. Like a flexi cap category, most of the funds are at, say, 70% into large caps. In a large and mid cap category also, almost 51 to 55% allocation is towards large cap. So there is no other category which is available to the investor where mid and small cap exposure can be 50% minimum. And that is where the uniqueness of this fund comes, because when funds, other fund categories and funds were given a free hand to be anywhere in the market cap segment, they chose to be largely in large caps, and we've seen that historically. But with this mandate, this category is expected to have a larger exposure, or this fund is expected to have a larger exposure to mid and small caps. And there are a lot of benefits of mid and small cap category also. So you have the stability and the liquidity benefits coming in from the large cap category, but you have the sector exposure and the broad basing benefit coming in from the mid and the small cap category. And you see how. I'll go back to the previous slide in a bit, but just look here. There are a lot of sub industries which are covered by mid cap 150 and small cap 250, but not covered by Nifty 100 at all. This is a list of the unique sub industries which are covered only by mid cap and small cap. And if you see, a lot of capital good names, you'll find here, like your diesel engines, fasteners, explosives, castings and forgings. And these are the sectors, which are expected to do well when the broad basing of the economy and market is happening. So even the Nifty small cap 250 index, if you look at, there are multiple sub industries which are present here and not being, not having enough exposure in the Nifty 100. So if you again look pictorially look at the split of the constituents of each of the benchmark, or the large cap or the mid cap and small cap, you will see the pink bar is representing financial services, which has more exposure in Nifty 100 as compared to mid cap and small cap indices. If you look at this starting pack, the blue pack at the start, which is your automobile, capital goods, chemicals, construction materials, they all find a higher exposure in mid and small cap and not in Nifty 100. And these are some of the sectors. If these sectors are doing well, and how else can an investor take an exposure to these sectors and to this part of the growing economy? Multi-cap would be a way, because unless and until the fund increases its exposure to mid and small cap, it's unlikely for the fund to cover all these sectors in the requisite proportion. Also, mid cap, small cap, everything has grown since 2012. So the market cap of the first large cap stock, it was 2.4 lakh crores in 2012, and now it's 17.82 lakh crores in 2022. Similar is the case with mid cap stocks and large cap and small cap stocks as well. All have grown. The first stock, of each of these, under each of these category, has grown by more than 5x. Just some thing on the portfolio. So because of this mandate of minimum 25% mid and small cap and large cap, of course, because of this mandate, it has become this mandate has helped the fund to get much more diversified and cover multi-style and have more of better mix of growth and value style, cover more sectors which are covered only and more by mid cap and small cap indices, cover more themes or those themes which can get covered through mid and small cap indices, because as I said, manufacturing theme is covered much better when you add mid cap and small cap indices to the investment. And then, of course, the philosophy remains the same, which is growth at reasonable price, which means that we would not be buying deep value companies which are very, very cheap but structurally low growth. Neither would we be buying very, very expensive companies at any price. We are very much here to buy growth oriented companies which are available at a valuation which is reasonable, which is not very, very expensive. And the way we wish to run this portfolio is have 50% of the portfolio where stable earnings, earning stability would be there, by the companies who have predictable quarterly results. The results are in line with the commentary coming in from the companies quarter on quarter. And the balance 50% would be into companies which are capable of announcing earnings surprises. Like I mentioned at the start, the fund manager would study the company in detail, meet the company's management, take a call and study the industry dynamics as well, and then take a call to take a position into this stock, into this company, wherein the market is still building its conviction. It's not yet convinced, and as the conviction of the market keeps growing and more people get convinced, there will be a valuation re-rating, as we call, happen, and the stock prices would go higher. But the fund manager here has already positioned himself and convinced, and he's now expecting that the larger market would get convinced and the market would be okay to pay a higher multiple for that stock which he's taken position to. But obviously, that is a high risk, higher reward scenario. So 50% of the companies would be with earning stability, and 50% of the company would be with this earning surprise, which would largely, help in creating better excess returns. This is our philosophy, as I said. Rahul Singh, who's our CIO, Equity Chief Investments Officer, Equity, will be managing this fund. He has a 23 years of experience overall in capital markets, and he joined us in 2018 post his stint with Person Capital Investment, and he also had successful stints with Standard Chartered Securities and Citigroup. He's an alumni of IM, and he's been a finance professional through and through. These are three of our NFOs, new fund offers, and we would like to highlight here how, what percent. So they have been 90 to 100% in quartile 1 and 2 since the time they were launched, or in the last 1 year and 6 months period. And these were recent new fund offers for us. And these are all three being managed by Rahul. And this is the performance of his other funds for everyone to notice. We are sitting at the funds are sitting at good ranks across periods, as you can see, third, fourth, or first or second rank. Business cycle, the last fund is at around 1 and 2 ranks in any period that you pick up. Balanced advantage and multi-asset opportunities, the equity portion of multi-asset opportunities managed by Rahul. Again, these funds are at third or fourth rank, which is quartile 1 and 2, for any period that you can see. So this gives we would want to pass on our conviction and give confidence to the investors of the existing funds that are being managed by the fund manager and by the fund house. Just giving you a risk return matrix, our balanced fund has 82% large caps and of course 18% mid and small cap. Multi-asset again has about 82% large cap, and business cycle fund also is close to 70% large cap. So multi-cap is another fund because we plan to run it as 40% large cap, 35% mid caps and 25% small cap. Anyways, 25% each is anyways the mandate. We just loaded up a little bit on large cap and mid cap. And as you can see, the benefit of relatively higher exposure to mid and small cap can come in from this category. And why mid and small cap? Of course, I did go around explaining our perspective on that. As you see, the balance advantage, the number of stocks and the top allocations also. So multi-cap will be much more diversified in terms of number of stocks and in terms of top 10 and top 20 allocation. That's the higher risk, as the small cap and the mid cap percentage increases because they are relatively less liquid as compared to large caps, the number of positions automatically increase. So there will be larger number of stocks in multi-cap, around 70. You could have average number of, currently the peer set has about 72 stocks in multi-cap, which is higher than large and mid-cap as well as flexi-cap also. And these are the sector exposures. These are the fund details. So the NFO is already started, 16th to 30th. Fund managers, I did mention. Tejas Gudka is the equity co-fund manager, and our debt CIO will be managing, Murthy Nagarajan, will be managing the debt portion of this fund. And the benchmark is Nifty 500, but the benchmark split is at 50, 25, 25, whereas we plan to run it as 40, 20, 40, 35, 25. Once the deployment is expected to happen in 1 to 2 months, depending on we getting the right prices. So once that happens, we plan to settle at 40% large cap, 35% mid cap, and 25% small cap, with 2 to 3% cash allocation, as it's the case usually with all the funds. We need to keep some cash. So I think I will stop here, and if there are any questions, would be happy to take them.
Yeah, hi. So Shaily, it was, I think, covered the larger part of what multi-cap funds are and where the industry is. So I would just request you to stop sharing the screen for
Sure.
now. Okay, so we have a few questions and I will take them up quickly. So the first question is, will this fund be investing into overseas market, as in the international equities?
No, we did do the enablement in in our scheme information document, but we don't intend to invest in overseas in this fund. Enablement is another part. It's important to enable and keep. Our idea of investing into overseas is that if we don't find risk from the risk return perspective, if we don't find enough positions here in India, then probably we could look abroad, or some specific theme and sector which is giving a very different allocation or a very different experience there, like a digital or a tech, then we could go. Like we have some small allocations in our digital fund we had taken, but otherwise in this NFO we do not intend to go overseas.
Sure. So we saw that the fund will be constructed as 40% large cap, 35 mid cap, and 25 small cap.
Yes.
And larger part of the population in India invests in multiple funds at one time. So having an exposure to this one particular fund, would that mean that customers can skip investing into a mid cap or a small cap fund separately and have a consolidated exposure with one mutual fund?
Mid cap and small cap fund. Sorry. I was looking for one slide which I can show. Harsh, can you just repeat the question, please?
Yeah. So what I was trying to say is, if a customer is looking to invest into across all the, categories of
Categories.
market capitalization, so should he skip small cap and mid cap because he's exposed to a multi cap fund of Tata AMC, because there's a sizable portion of small and mid cap in the portfolio?
Yeah. So see, as per the risk profile and the capacity to take, risk, if the person can overall decide that in a small cap, I do not want to exceed, let's say, 25-30% of the overall portfolio, and accordingly then allocations can be given. Even if out of 100 rupees some 5% is there in a pure small cap fund, but through this fund, if he's taking a 10% allocation to, let's say, a multi cap fund, the small cap exposure will be 25% of this 10%, which would be 2.5% on his 100 rupees. So he already has a 5% small cap. He's just adding 2.5% small cap through allocation to this fund. And overall, if it doesn't cross 10-15% of overall small cap, let's say, the threshold which he set for himself, why not take an exposure to this fund? Because see, this fund can, a minimum 25% of course needs to be there, but it can maneuver between, the balance 25% can be shifted more towards completely on large cap also, or it could be loaded to mid cap and small cap also. So that flexibility is there, but yet the minimum is higher as compared to any other category. Of course, a pure large cap and a pure mid cap and a pure small cap fund is there, but this could form part of the overall portfolio. Also, one more thing, if he doesn't have, let's say he's a moderate client and he doesn't want a pure mid and a small cap exposure, because that particular investment would obviously be more volatile than this investment, because it also, this investment of multi cap also has the stability of large caps to the tune of 40 to 50%. So if the journey could be much smoother in this case, and if clients can would want a smoother journey, see, it's important to be present in the journey and stick there for the long term. And if this smoother ride helps the person to stay invested for a longer period, then definitely it's a better option, rather than getting yourself into a very volatile fund and not having the temperament to stay invested. So exiting the runway, rather than exiting the
Yeah,
runway, better than have a
yeah.
smoother.
So the customer experience, to see the returns and
Yes.
sail through the volatility is better when
Yes.
looking at this. So Shaily, one last question. So, previously there was this multi-cap category was previously there, which got renamed as flexi cap, and now it is again called, and then SEBI
Yes.
introduced this multi-cap as a category. So, some investors still, have that confusion as what exactly is a flexi cap and what is a multi-cap now. If you
Okay.
could clarify on that particular
Yes,
question.
I will. I would want to share my screen. It's an internal slide, but you asked a very, very pertinent question there, and I think I should be so sorry, covering that. It is a very busy slide, but I would just want to highlight two, three things here. There were a lot of multi-cap earlier, which were there in the earlier avatar, which had become too big. And they said, like SBI, HDFC, Axis, Kotak, many of the funds. And, all of these people moved to FlexiCap. And because a larger, larger AUM moved to FlexiCap, very rightfully, because those funds said very clearly that we uh, it's with such a large size, aligning ourselves to the new mandate will be very difficult. So they moved their funds to the new category called FlexiCap, where they had the free hand. However, the conviction in the newer multi-cap category or mandate was quite high, and all of those funds who moved to FlexiCap, they launched their own multi-cap, and now including us, we've also come. So from that perspective, it is mandate. Earlier multi-cap mandate was go anywhere, and when it was go anywhere, most of the funds were sitting in large caps to a large extent. And they were too large to align to the new mandate. So many of them moved to flexi cap, saying that let's safeguard this asset because it's large and let us manage it with a free hand. Maybe if we want to have more large caps here, fine. And they went ahead and launched multi-cap funds like us. And that category is also quite big now at 67, 70,000 crores. And the net flows there are also very encouraging. So, but also I would again like to reiterate amongst all the categories that we can speak about, large and mid cap, flexi cap, focused funds, or any other category. This is multi-cap is one category which will help an investor uh, stay at a higher exposure to mid and small cap, because of this mandate of minimum 25%. It will always be at a relatively higher allocation to mid and small cap and reap the benefits of that.
Correct. So I think previously, as the category was defined as multi-cap, but largely the fund managers were sticking to a large cap as a mandate,
Yes, yes,
and it was nothing but another large cap of that same AMC. And now it's
yes.
with this new era, these are true multi-cap funds, where a customer will have sizable portion of small and mid-cap funds.
Yes, so
Uh,
FlexiCap
so
can
yeah,
also be part of the core portfolio, but for all those clients who would want to have a continued exposure to relatively higher exposure to mid and small cap segment, this is expected to be, or this is the category in the to be part of the core portfolio.
correct. So yes, Shaily, so with this we come towards the end of our session today. It was extremely insightful session for our viewers. Thank you for your time to conduct this. And
Thank
to
you.
all our viewers, thank you for attending today's session. In case you want more information about the Tata Multicap Fund, please log into the Moneyfy app, and we will be happy to assist you through the app. And definitely you can open your mutual fund account within minutes and start your investment journey either through SIP or a one-time investment. Uh, so yeah, Shelly, thanks for your time. It was
Thank you, all
wonderful
the
having
viewers.
you
Thank you
on this
for your
session.
time. And thank you, Manify and Harsh. It's always pleasure to be coming and sharing and exchanging thoughts on the Manify webinars and platform. Thank you.
Thanks,
Our
Shelly.
pleasure.
Thanks, everyone.